This video is all about how to buy real estate with little or no money down. So what if I told you that you could buy your first rental property without having 20% down, maybe without even spending thousands of your own cash, if you know the right strategy and paperwork? So that's key. Many new investors are stuck saving cold cash while seeing others make deals happen with much less. So by the end of this video, you're going to understand how I use creative strategies about financing, got access to no money or low money deals, and what not to do so you don't lose everything. Now, who am I? My name is Nancy Wallace Lobbs, and together with my daughter, Kelsey Leka, we founded Money Making Mamas. I personally have been investing since 2006 in single family homes. I teach my daughter, I'm teaching my daughter how to invest in real estate. She's kind of new to real estate investing. Her story is that she had a corporate Fortune 500 job, and after her second child, she wanted to stay at home, but her life was based on a two-income household. So she came to me, and she'd always been on the outskirts of investing. So after talking for a little bit, I kind of walked her through how I was walked through, how I learned, and how I now teach other people. And she got her first investment property, and she ended up making some money because she wholesaled it. So that's what our mission is to help other moms invest in real estate and make money. We also have a podcast. I didn't mention that, but you can find us on Money Making Mamas on Spotify, Apple, YouTube, everywhere that you can listen to podcasts. So my journey, when I first started back in 2006, oh my gosh, I can't believe that's been almost 20 years now. I started out by doing the old, let's save 20 to 25% down to purchase an investment property, because that's what I learned. That's the only strategy that I knew, that you had to save up. So if I bought a $150,000 property, I had to come to the table with $30,000. Now, in the very beginning, we had saved up that money, right? But after a couple properties, it's like, dang, I always felt like I was just in the, saving up, cutting corners so I could buy real estate. And I was just asking myself, well, I thought you made money. Where's the money? Show me the money. So I ended up, because I ask a lot of questions all the time, and I started asking other investors, well, how do you scale? How do you scale? And they're like, well, you have to find, these other strategies. But what I found was that people weren't really forthcoming, or they didn't give you all the details, or you had to pay them for it, right? So I went on a journey of discovering strategies that let me invest faster. My two main no money down strategies I use today are subject to existing mortgages, meaning I'm basically taking over the seller's mortgage, and there's a little bit more to it that we'll get into, or using an option, which I'll explain in a bit, and other people's money. So, but there are three things that you need to watch out for, and whether you do those two strategies, and that's the paperwork. You have to make sure everything is documented properly, the insurance and how the insurance reads for who's insured and the property and everything, and then what's the exit strategy when you use those kinds of strategies. So now, how successful really are no money down strategies? Well, I did some research because I wanted to let you know, right? Because you hear people all the time. I mean, if you listen to Facebook and internet and all of that, you would think that, hey, that's just the only people that don't know how to do it is you and me, right? That we don't know how because no one's telling us how to do it, right? Then I'm talking about the no money down. And so no money down strategies are very less common. I could kind of see it. My first investment property, I shared in one of the videos that we got a loan from Countrywide Home Loans back in the day, and they were giving money to anybody that could breathe. I mean, it was so simple, and they were part of the big, mortgage, part of, not all of it, but they were part of the big mortgage break meltdown because they were giving out subpar loans. So they literally offered us a 90-10-10 on a $150,000 property, meaning that I didn't have to come to the table with any money. Now, we didn't do that because I didn't even really get a 90-10-10. And when it sounds too good to be true, I'm very skeptical, right? So most sellers and their circumstances favor a buyer bring at least some cash to the deal. And I can tell you, in all the years that I've been investing, I have done no money, like where I'm like literally no money's coming out of my pocket. Now I've done it with, I've bought properties with $100. I've bought properties with $5,000, and I've bought them with, the 20% down. But I've never bought a property where I didn't have some dollar amount going towards the deal, either for an inspection, as I said before in the other video about when I'm analyzing deals and I'm estimating repairs. I 9 times out of 10 have an inspection done on the property when I can. Sometimes there's not time because, it's a foreclosure or whatnot, but most of the time I get an inspection. So I'm at least spending that. And then there's closing costs. So I am going to give you a couple of scenarios where I have paid a little bit of money. So you don't always need 20%. I guess that's the point. So no money down strategies require special negotiation, a unique seller situation, or specific creative financing scenarios, and they are generally considered rare in the wider market. So if you were to meet people and they were telling you that, they were buying all their properties with no money down, maybe, but I would like for them to show me how that works. So, okay, can you really buy a property for no money down? True, no money down investment property purchases are rare. They do happen. And my research showed that under 10% of all investment properties for all time do that. So that must be all the gurus that are teaching that, right? Those are the guys that are doing that, and gals. But the majority, which is 90% of real estate investment deals, involve mortgages with a down payment. Now, it doesn't have to always be 20%, or you don't always have to furnish the 20% because you can use other people's monies for that. So there's different scenarios where you don't have to use all your cash, you can use someone else's. And that statistic that I just quoted you was courtesy of Rocket Mortgage. Thank you so much. So now don't let these 3 things hinder your deal. So first of all, the documents, you have to make sure that they're correctly filled out and executed properly. So when you take over a subject to, again, you're taking over, first of all, you have to be able to explain that to the seller, because sellers are like, what are you talking about? Sellers' mindset are that they're selling the property to you. You're going to come in and give them cash, pay off their mortgage. They're basically going to be done with it, right? They don't have to do anything. When you take a property subject to, the mortgage still remains in the seller's name, right? Because if you try to transfer it in your name, you're going to possibly trigger what's called the due on sale clause. Some lenders, and they're getting more savvy about it, but some lenders, when they see that, because they're trying to avoid people forfeiting on those payments, but some lenders, if they see that there's an indication of the way you transfer title is through a warranty deed. So that's a separate piece of paper, but the mortgage stays in the seller's name. And you're simply making payments to the mortgage company. So you have to also get the insurance coverage under your name. And again, it's a little bit of a sticky wicket to do that, because you do have to have the full-on cooperation of the seller, and the insurance policy has to be written in a certain way that, yes, the seller's name's on it because their name's on the mortgage, but you are also a co-insured. I forget the exact title of what that is. Or your name or your entity names, because on the video I did about do you need an LLC, right? You can watch that one next. I talk about, setting up insurance in your LLC's name. And then the exit strategy for when you buy subject to, because you might not want to keep that forever. So the subject twos that I've done, my exit strategy has been usually to sell the note, because that's what you're doing. You're creating a note, and then you can go and sell it, right? You have to season it, and that's a whole nother video. Okay, how I bought properties with little or little money down. I've never done zero, but I have done a little bit. So at first I used the traditional investor loans. I saved the 20-25% down, buying properties step by step. It was a very slow and arduous process. And I did that like 3 properties in 3 years, and the growth was super slow. And again, I was like, okay, because it takes a while. My husband and I were both working jobs at the time, and I was a 1099. So we were it felt like we were scrimping and saving to buy rental property, and it just didn't seem like it was making sense. And I was like, why are we not making serious money? It didn't feel like we were building wealth. We were, but it was kind of transparent because there was no we were saving so much. Like if there was any cash flow, that just went into the kitty to buy the next rental property. So if I own properties, even though they bring in cash, and I had the tax deduction, so I felt like I was always saving and not growing. And then I discovered this thing called creative financing, and literally it took me months to ask everybody that I ran into. I would say, well, how are you scaling? I really wanted to know how to scale, because that was my whole thing. Well, if you always have to, come up with 20, 25%, even if you're buying a $100,000 home, if you're always having to come up with 20%, I mean, that's, $20,000, and you do that 4 times, that's, $80,000. So, and I do buy like lower end, like I have bought $50,000 properties and used 5,000 as the down payment. So that's like 10%. But I discovered creative financing and by going to networking, and people didn't fully share how they worked, or maybe it was that they were sharing it, but I didn't understand it. Right. And so I had to keep going, what? And if you know me, that's what I do. I keep asking questions, and I had to also learn what to watch out for. And then I invested in some coaching and mentors. And that's really in the video that I talk about how to start, in my first video in this series, how to start real estate investing in 2025. That's what I talk about. It's not that I lacked the resources, but I did lack the education. I literally lacked the education. And that's where I got it, was in the mentoring, coaching. So it wasn't just about learning new strategies, but getting access to a network and seeing deals done and learning what works in real life, not just like, oh, okay, theory. Okay, this is how you structure it. This is the paperwork that you did. So just like when I bought my first investment property, I had a mentor coach. I didn't pay for her in the beginning, but then later on I did pay for coaching so that I could end up scaling my real estate investing business. So the strategy, subject to existing mortgage, how it works. You literally take over someone's existing mortgage payments, and here's some key requirements. You have to have a seller's agreement. So the seller has to agree to that. It's not like you can just, put that in a contract. The seller has to agree that, hey, I'm not, paying off your mortgage here. So if the seller wants to go and buy another mortgage or buy another property, so when the lender runs their credit, guess what? That mortgage that you're taking over is going to show up on their credit. So you have to know how to not avoid that, but how to deal with that, how to assure the seller, well, that's okay because I'm going to cover it. So if I was meeting a seller for the very first time and I was telling them, oh, hey, I'm going to buy your property, I'll give you, $1,000, and you can move out whenever you want, and I'm going to take over your mortgage. And the seller's going to go, what? that doesn't work for me. What if I want to go buy another house? So you have to be able to explain that. You have to have the proper deed and title, and understanding that the loan being called due is a risk, right? So meaning that what that means is, if, let's say, the lender finds out that Nancy is now the owner of Mr. Smith's property, Mr. Smith deeded it to me, I'm taking over his mortgage payment, but the mortgage is still in his name. The lender can literally say, okay, we want to be paid in full. It's called a due on sale clause. That's what it means. And you get like X number of days to pay off the mortgage, or they start taking action. So what you want to check for is the mortgage assumable, or can you take over the payments subject to the mortgage, though not formally assuming, right? Now, I will give you, so one of the properties that I took over, it was very interesting. So we ended up, and it's one of the case studies I have, so I might wait to talk more about it. But what the lady owed on was not a traditional mortgage. She had used a home equity. Her mortgage was paid off. It was her home equity line of credit that we were assuming. So I didn't know this until after we assumed and had already closed on the deal. But if you have a property, I had a little freak out moment because she had a open credit line of credit. So if you're familiar with home equity line of credits, if your house is worth $100,000, they'll let you borrow, $80,000. In this case, I think we were taking over $40,000 or $50,000 on the note. Well, she could walk in the bank and say, hey, I want to take out another 10, 20, 30,000, right? So she still had access to that equity. So we had to, and we found that out after we closed on the property. So we ended up making me and my partner made a strategic decision to like offload that property ASAP, right? We ended up owner financing it, but in the caveat of the owner financing, we said that the new owners had to refinance that property within 12 months. So, but that was a lesson learned. So what to check? Are the terms of the existing mortgage, interest rate, remaining balance, and payment schedule? So what I like to do is get the seller's login to their mortgage account, which means I need their social security number, right? I need to know what their security questions is. And I get this all in writing. So if it ever comes up, so the seller doesn't feel like I'm taking advantage of them, or it doesn't look like I'm taking advantage of them. So you put everything in writing. And then again, you have to know how the insurance is going to work. So it probably sounds more complicated. It's not a complicated strategy, but it does require due diligence on the paperwork that you need to complete. And this is why it's good to partner with a title company that knows how to do this. Now, my strategy B is using an option. So funny story about options. So I had an opportunity to buy a property, and I know how to buy properties in my self-directed IRA, which again is another video for another time. And but at the time of the opportunity for this property, and I had it under contract, and I was like, okay, I do not know how can I buy this property, because I was buying it for $75,000, and I did not have $75,000 in my self-directed IRA. I had about, I don't know, $1,500, because I had the money dispersed on other properties, right? So I was on a podcast, and behind the scenes, I was explaining the situation to one of the co-podcasters, and they said, well, why don't you do an option? And I said, well, what's that? They said, well, it's an option, and maybe some of you that are a little bit more familiar, like in real estate, you put a property under contract and you have an option period, right? So that means that that's the time, it might be 7 days, 30 days, that's all negotiable, and you might pay the seller like $100 or $150 to have an option period. But this was the option to buy this house using my self-directed IRA. So the way I structured it is I literally created because even though I'm a real estate broker, there is no such thing as an option contract. It doesn't exist. I Googled it. So I ended up creating one. And I even called TREC, Texas Real Estate Commission. I go, do you have such a thing? No, there's no such a thing. Okay. So I ended up creating my own document, and I ran it by the self-directed IRA company. And I said, can I use this? They said, yes. I ran it by the title company where they had an attorney. Yes, you can use this. So it was a contract. So basically, I used $100 from my self-IRA to purchase the option on this property. Now, the way I was going to buy the property is I'm going to take over the existing mortgage, right? And then I'm going to owner finance it. So meaning that I'm going to create it, but I needed to use private money lending to close the deal, is which I did. So for example, I put it under contract for $100, and then I used other people's money so I could close the deal. So here is where I use strategy A and B. So strategy A, taking over the existing mortgage, and B, we needed $7,000 to catch the seller up on their mortgage, right? So we secured the contract with a $500 option, and we took over the mortgage payments, right? But in order to reinstate her, we had to pay to the mortgage company $7,000. Now, when you're taking properties over subject to the existing mortgage, in my experience, I have found that you can pay more for the property because in the long run, the seller makes more, and you're taking on a monthly payment as opposed to 20% down. So the seller was behind $7,000, and I know a lot of people that have small dollar IRAs, and I use them as private money lenders. So I reached out to one of them. I said, hey, can I borrow $7,000? They said yes. So we got them all caught up. So my payment to that lender was, once we closed, we got some money back, and so we just paid off the private money lender. So we used the OPM, other people's money, to catch up the mortgage. We made sure to get all the login info for the mortgage company so that we could just they actually took payments online. So that was very easy because we took it from our bank to the mortgage company, and we made payments directly to the mortgage company. We wrapped it, meaning that, so we took over, me and my partner, we took over the mortgage, and then we sold it to an end buyer. And this was the property I was saying that the mortgage on it was actually a HELOC. It was a home equity line of credit, which is scary. It's not it's where the seller, now fortunately she didn't have that ability anymore, but we didn't know that. And I had to call the bank and kind of pretend like I was the seller to find out what the terms and conditions of the home equity line of credit was, just so that we wouldn't be stuck with an additional, $50,000, $60,000. So based on my experience, I've never done a no money deal. I've done little, where I have a little money down, because there's always inspections, utilities, repairs, etc. Low money down, that's what I say. And these strategies can work, but only if you're rigorous and find trustworthy mentors or legal help, right? So you have to have someone that can walk you through. Yes, you could watch a YouTube video, but if it were me and I was doing it for the very first time, I would want someone to check my paperwork, make sure everything is correctly done, and develop negotiation skills. Because when you're talking to sellers about these types of strategies, they're not going to understand it. I mean, this might even be, since I've been doing it for so long, I have to remember to, not use so much jargon when I'm talking about real estate investing. So it is a great strategy. It's not that hard. It's just a process, right? So it's okay to start slow. So if you have, the 20, 25%, don't let not having money prevent you from investing. So creative financing can accelerate your investing. And if you're working with a trusted mentor, you can actually, purchase properties without having the 20, 25%. So it just takes a little due diligence and the ability to kind of think outside the box. So what are my takeaways for buying properties with little to no money? Well, I don't know about no money down deals are rare. They just are. I'm just trying to think of any scenario in the whole time I've been investing, and the only one I can even come close to was the $100. Low money down deals are more common, where they require strategic negotiations, using a network of mentors and private money lenders, and that you have to make sure that the documents are prepared correctly to protect the investor. I mean, you protect you. Traditional investor loans still work for most of the investors out there, but your action is to find properties that make good investment. Use a network of trusted mentors to help you determine the best financing options. So sometimes you have access to cash that you didn't even know about. So my husband and I, over the years, we have tapped into his 401k to buy investment properties, and then you can pay it back. So if you have a 401k, you can borrow from it. And that's exactly what we did with my daughter. She had a 401k from her previous employer, and we borrowed from it, right? And then she just pays back herself. You avoid, I think you have to pay taxes on it, if I remember right, but there's no penalty depending on how you structure it. I'm working with someone right now that has a family member that wants to get into investing, and they actually have money. So they are going to be the money person. So there may be people in your circle that have access to cash that you don't, but they want to partner. You do the work, you find the deals, you negotiate it, and then they're your financing partner. So there's all different kinds of ways. When we talk about creative financing, we're talking about going outside of traditional lending and making it work for you and your situation. So if you have any questions, give me an email at nancy@moneymakingmamas.com. You can also direct message me at money_makingmamas on our Instagram account. And if you want to book a call, hey, there's my QR code. Scan that in and schedule some time with me. Now, don't forget, watch my next video. And it's going to be talking all about how to analyze a deal. And the one after that is about, do you need an LLC? So you want to make sure that you're getting all your questions. I'm looking over because I'm trying to see if I can see the last video in this series. Oh, yes. Oh, I can't believe I forgot this one. This is why I started this. Someone asked me, is it worth investing now in 2025? And yes, it is. And I have a video for that too. So go ahead, click above, watch those videos. Thanks so much. And if you know someone that needs to hear this info, please share as well. You know how it helps that YouTube algorithm. Thanks again. Have a great day. See you later.